All right, good, I guess afternoon at this point now, everyone. This is Event Trader, about to be joined by chart trader Brett Manning, of course. Brett,
Yo.
how are
Hey.
you doing outside of rolling around in your profits on the Euro short here?
Well, the profits have shrunk, but
Yeah,
still,
I suppose
I
so.
mean, it's we were in the same place we were over the last several days, and we're past the ECB now. So,
Right, right. So let's go through the ECB and then we'll circle back around to this Euro short trade, see where you're going. Did you bank any this morning out of curiosity?
no, no.
Okay. Um, so
I'm looking
anyway,
for parity here. So,
yeah, no, that's I think that's a pretty fair lookout. Well, like I said, we'll roll around back to that in a moment. So just I'll go through and I'll recap what went down, Brett, and then we can take a look through
okay.
around. I'll just in the press release, and then we'll go through Draghi's press conference. But I think that it was definitely a dovish tilt in terms of what the ECB hit. And just to recap, it was the 10 basis point cut in the deposit loan facility, the DLF, which was generally in line with expectations. The Doves would have had it more of a 20 to 35 basis point cut, and that still is kind of the longer term outlook for this facility. But overall, pretty positive there. They also put in their QE program, as I had stated yesterday. People were looking for about euro 600 billion in total asset purchases. They left it as open-ended, so the hope was at least euro 30 billion a month. They came in at euro 20 billion a month, but again, people were fine with a little bit lower monthly purchase as long as that end date was hit. And considering that they left it pretty open-ended, I think that was enough to appease the audience there. We also saw them. Let's see, we had the QE, we had the rate cut. We also saw them. Just trying to recap here for my piece. Sorry, Brett. Just
No problem.
trying to recap everything that they did there, and the place
They
I was
extended the
looking didn't
forward
have
guidance. We
extended the
got the
for
tiered system.
right extended the forward guidance, which again they left that pretty much open ended. It looks like it's going to be really tuned into the to their inflation projections, which I think is going to make that a pretty important metric going forward. They did the tiered lending, which is good for, which is viewed as a positive for the banks, as some of the banks won't be as crippled by the negative interest rate terms as previous. So, I think that pretty much sums it up. Am I missing anything?
Okay, so I think the main thing that they did today doesn't fall into any of those categories. The main thing they did today was hammer home about 17 different times in 17 different ways that this is a unique situation because they don't have any fiscal support.
Yeah, there is definitely. I mean, we've certainly seen them hammer the governments in the past on fiscal support, but this was definitely probably the most direct
Yeah.
commentary from
I mean, he must
Draghi.
have included that in his answer to every single question at the tail end as a tag.
Yeah,
And again, what we need is more fiscal support. Like it was the constant tag to every answer.
right. And one of the funny things I saw was his comment where he kind of called out the Dutch central bank president who had hit out against central easiness. The Dutch have a 50 billion euro plan that we're just waiting for them to put into action here.
Yeah,
And
exactly.
I think it was the bottom line tone was, look, do we want to do all this? Probably not. But since we're getting zero help from, it's particularly the northern governments that don't want to budge on anything.
And the southern governments can't.
Yeah, yeah, and
So there you go. And it's the reason why I'm short the euro. And I would just like to also note that Japan, China, and the United States have done large fiscal stimulus over the last couple of years. It's just the EU that hasn't. So
right.
that's why the ECB is the one suddenly doing a whole bunch of QE right now. And that's, I think, the main point that he was making.
Yeah, and I would completely agree with that. And we'll see if that pushes it forward. I just found it really funny, like you were saying, he hammered that point home as much as he could, and then to specifically call out the Dutch, it really shows the difference between the southern and northern economies, and,
Absolutely.
and that's kind of why I think we'll see a northern euro more
I
than
think it's
anything.
reasonable, yeah.
That seems to be the end scenario for that. So, Brett, just in going through some of these, I posted the press release from each one. And I'm just curious as to your take of, most importantly, the APP purchase possibility. I found the most interesting because they're going to buy assets with yields below the interest rate in the deposit facility to the extent necessary. Now, one of the things that they didn't do that I think the markets would have liked to have seen was raise their ownership limits from 33% to 50%.
They didn't.
They did not. Now, we've seen
Right.
in the past there being a concern that, yeah, this QE program's great, but they won't have any ability to buy anything because nothing, they bought everything up that they could that falls in under their realm. Now, Draghi was
just on that real quick, the only thing that I saw him directly do to comment on that was say, just in a really passe way, we can go for quite a long time without the need to raise or talk about limits.
Correct.
That's what he said, and that's it.
Correct.
And then that was, yeah.
He quickly tried to nip that concern in the bud. But
without any specifics. You'd think that there would need to be some precision there, just said quite a long time.
Well, and that's why I'm curious on your thoughts on this in terms of specifics. Where, and anybody that wants to follow along, this is under the VGK symbol at 9:42. I posted it, and it says today's decision extends this possibility to the private sector part of the APP, namely the third covered bond purchase program, the asset-backed security purchase program, and the corporate sector purchase program. So from my understanding, they could go in and buy any corporate debt that they want to from this.
I think that's the implication, exactly.
Yeah.
That this is going to be as needed.
Right, and I think the key aspect for this is them buying the bank bonds, which was something that people wanted to see in order to kind of soothe the terms of the bank bonds and allow the banks themselves to open up a little bit more borrowing from the lending facility too. So I really think that this could potentially grease the wheel, given that ability for it to purchase some of the private sector goods. Of course, that's always a slippery slope when central banks being able to pick between winners and losers in the corporate world. But do you have any thoughts on that?
Yeah, there's two issues. I mean, one is that it's like some of the problems that we've seen in the past, where you create a metabolism that's self-sustaining without there being the need for some new kind of performance. So you can, it's just like a body that you gradually put more and more on life support. You accommodate all of its needs, and then it doesn't have to do anything, really. They've tried to incentivize more lending, but it's not necessary, especially if they continue to support, the banks that don't. So I'm not sure that this necessarily sets up a metabolism in the banking system there. It's one to make sure that people, because you're always so concerned about failures and people starting to lose confidence and counterparty issues, that you want to really make sure that you can create conditions such that people believe that it's impossible for major financial institutions to have that kind of risk in terms of perception in the markets. But at the same time, by doing that, by alleviating that potential for perception of risk, you're creating this kind of metabolism of existence that doesn't take any kind of forward movement. And you end up it kind of increases the likelihood, I think, of a sort of Japanization process. Which I think is the other point that emerged today was, I think, really this isn't about the actions that they took today were a more aggressive move, I think, maybe than people had been expecting, especially given recent rhetoric. And I think that he did a pretty good job of suggesting that it's not because things are necessarily cratering right now, but it is the kind of risk of, and the way that he put it was re-anchoring inflation expectations between 0 and 1.5%. It's that risk of having the entire system become inured to a long-term inflation expectation that's well below target, and that he's starting to get worried that that's happening right now. And that's this whole process, the same thing that we've talked about with the Fed, where they're just, they're afraid of becoming the next Japan, and I think the markets are already kind of classifying them that way. But I think that that's why you see the likelihood that this this type of step can even be extended in the future, and if they are the unique economy, and I think this really gets to the big thesis statement, the big point of all of this, if they're the only major developed world economy that is incapable of having a fiscal component to stimulus, then the slippery slope into the antlion's den of a Japanization over the long term, of really low inflation expectations, becomes almost inescapable. And I think that they're already at the point of contemplating that. So I think that everything that happened today was designed to try to battle that.
Right, and I would even think Japan would take umbrage with that statement because I don't think Japan's ever had rates this low, right, Brett?
You're going to have to call it
Japan Japanification.
What about but Japan had the three arrows. Japan had fiscal stimulus. They can do other things. They can do more than just the central bank, even though the central bank has done crazy things in Japan, and even though they've been mired in this process for a lot longer than the EU, the idea that if the EU moved into this situation, it's the reason why we're short the euro. The reason is that as the dust settles here, that the more important thing, besides the fact that this could lead to some new resiliency, besides the fact that there's a suggestion that a no-deal Brexit is more and more off the table, there's a number of different factors coming into play, that the long, slow slope here is towards some kind of crisis where you have to eventually deal with the fundamental underlying problem at the base of the existence of the European Monetary Union, which is coming more and more, I think, into focus for markets, that they are different from Japan, they're different from China, they're different from the United States, in that it's a massive, major, it could be seen as if you look at the European Union as a whole, if it were a country, I think it would be the biggest economy in the world, and they have no ability to use the fiscal channel at all. And so it leads the central bank into this slippery slope, and they're trying to get ahead of that at this point, which is the reason why we shorted the euro, the idea that they would have to do that. And I don't see how that's changed here in any way.
Yeah, no.
And I would think that it's going to become increasingly obvious that that is not something that getting out in front of it can change. It's a process of gradually coming to terms with an underlying fundamental reality that's almost a mechanical aspect of the situation. And I would think that it would just become a spiral of this kind of action unless we start to see headlines of some kind of European fiscal union, something where the northern economies are going to work and they're willing to support the southern economies in a more direct sense. And it seems like that's, just like you said the last time we talked about this, the political environment in Europe is such that seems less and less likely every day.
Yeah, and I mean, it's going to be something that we continue to see. I'll be curious to see how Christine Lagarde handles this because, she pretty much called out northern European economies constantly in the IMF about the need for fiscal stimulus. So I don't see this line of approach changing at all, but you're really starting to see that kind of line down the middle between the northern and southern central bankers that will continue to work its way into the politics, I feel, for each region. So,
right, absolutely. So there's a feedback I just want to address really quickly.
Yeah.
Somebody's asking when I reshorted the euro. I only shorted it once. I never covered it. I took a small trade, short the euro several weeks ago. I took it on, let me just point it out here just to be clear. I took the trade.
Yeah, that's September 6th. I was out of the office, so I'm assuming that was probably just an add-on.
I did not add to it. I have not, and I did not. I certainly did not short it in September. I shorted it on the maybe 16th or 19th or 20th, somewhere in that area of August, and I have been sitting shorted. I did not reshort it. Jim and I talked on audio saying that there is the possibility that if somebody did not take the trade, and I think that's maybe what this person's thinking of, that that might be a decent chance to add, although if I were not in it, I would not do that because I wanted to see it move one more time above 1.11 and then get rejected and move back down. But as far as my own position, I entered it sometime back either the 16th, 19th, or 20th of August, and at 1.1107 with a stop at 1.1207. And I have not moved that stop. I have not adjusted the position, and I see this as something that, I plan to be holding possibly until the end of the year, unless it comes all the way up and gets me, because I think that we're in the process that I've just described of markets gradually coming to realize that there is the potential for a kind of crisis point where the very existence of the euro is concerned.
Okay. But then, of course, we had the TLTRO. I don't think there's really anything of great note here. They changed some of the guidelines around it to make it a little bit easier for lending purposes. Changed the interest rate for the TLTRO3, which would be equal to the average rate applied to the Eurosystem's MROs over the life of the respective TLTRO3 operation, which is expected to give a little bit more favorable terms. And then they extended the maturity of these operations and are allowing them to pay back the maturity earlier than possible if needed. And then finally, we got that two-tier system for remunerating the excessive liquidity holdings, thereby basically making it some of the terms a little bit more acceptable for banks. It's exempting part of the credit institution's excess liquidity holdings. So, that's pretty much it on the actual changes. We had them lower their GDP projections for 2019 and 2020. Probably no surprise there, right?
Mm-hmm. Right.
And then what I think is going to be the most important thing moving forward on a quarterly basis is going to be these inflation projections.
Sure.
Because they were talking about when they started looking at things getting closer to 2% is when they would change it. And obviously, it doesn't look like...
Well, this is the re-anchoring dynamic that we just talked about. The idea that it's not just where inflation is at a moment, it's the idea that it's been down here now for long enough that it becomes this psychological slippery slope process. And if they don't have any way to send big money checks to people for real, like we do in other countries, then the magical incantations of the central bank can't pull anything out of there rather than shock and awe early on in the game.
Right. Now, these inflation projections, they were lower across the spectrum from 2019 through 2021. 2021, we see at plus 1.5%, so obviously nowhere near that 2% target. They didn't change their language around that 2% target, which some people were looking for, a little bit more of the price targeting that we've seen Williams talk about, I suppose, where some people were looking for 2% or above. They kept it near.
I saw your note on that. That seems like that would be a very smart thing for them to do.
I thought so, but obviously they felt that they were getting aggressive enough here. But their inflation outlook, Brett, this is kind of, we just talked about the importance of this forecast, as that will kind of run the time horizon for their QE program. It said reflecting lower energy prices and weaker growth. The weaker growth, obviously we've got that under consideration, but you've been following oil closely for decades now. And just curious as to what your thoughts are in terms of, because, a lot of people see inflation being lower due to energy prices as transitory a lot of the times. I don't know. That's what I'm looking for from you, to see exactly what you think of that included in this, and if you see anything that could flop this outlook around and kind of jet prices higher if we were to see some sort of squeeze in oil or anything.
Well, I think that they needed to have lower inflation projections.
Yeah.
It was part of the package. That's part of, delivering the shock and awe is having lower inflation projections. Energy is an easy way to get there, I guess. I don't know. Yeah. I don't know. I don't know what happens in the back room of the staffers doing their research for the ECB. I just know that obviously part of making it believable that they're coming in with a big stimulus package is being able to express that there's lower inflation expectations.
Right, and he did dismiss disinflation as a concern, I would say. So,
But I think it's the core issue is saying, hey, we're concerned that people are going to become, anchored to the idea that inflation in the Eurozone is 1% or lower. And that's that we have to do whatever we can to change that. And so here's the package.
Right, so...
and one thing I want to go back to. So when you kind of went quickly over the tiered rate structure and trying to deal with the banks, this just introduces another. As you talk about limitations of much debt they can buy. The other limitation that they're running into is how far into negative interest rates can they go without it being something that gradually undermines the functionality of the banking system. And Japan is dealing with the same thing. They're trying to come up with some magical holy grail recipe of different things that incentivizes the banks and also removes the pressure and allows them to continue doing interest rate-based stimulus and forward guidance around interest rates. But there's a wall that they're gradually approaching, which is the same thing that feeds into this big 30,000-foot picture of saying if you're the ECB, you're going to have to start moving around really uncomfortable, difficult pieces to move around to try to keep fueling the story that there's some kind of underlying stimulative structure in place because you can't do the fiscal stimulus. And he said, he came back to that a number of times, we wouldn't have to do these strange kind of maneuvers around the banking system if you guys would just do fiscal stimulus. He said that several times, that there are definitely, or the pension fund thing, there are definitely drawbacks to the policy that we have to do, but, we have to do it because you guys won't do fiscal stimulus. It's the same kind of theme. And he's willing to say the effect on the banking system is a problem. The effect on when for anybody who has investment return structures where they have to gain some kind of a return to pay off forward obligations of some kind, like insurance companies or pension funds or endowment funds or anything of that nature. When you take interest rates where they have, it just means you're going to be forcing large agreements, large contracts to be essentially to go bust. They've got to send out pension checks. They had obligations based on a certain understanding of interest rates. Those are now a pipe dream. And what are they going to do about it? Well, fiscal stimulus. It's more pressure on governments because then you get into a lot of workers in those societies, particularly with pension funds, where they can start clamoring politically for some kind of stimulus to move this back up. But it's not going to be the central bank.
Right. So I did hear him doing a lot of defense of the negative interest rates there.
Yeah, right.
So definitely trying to protect against that, some of the outlooks that we've seen from numerous sources over the last couple of weeks with regards to the concern about negative interest rates. So that seemed to me like something he was just trying to ease any negative reaction to some of this ECB stimulus that we're seeing.
Right, because I'm sure that there's segments of the population that would see it as extremely difficult and unpopular. But yeah, he made the case. You're exactly right. We know that it has problems, but those problems are nothing compared to the advantages given what we're looking at.
Right. So that was it. Overall, I thought he did pretty well, all things considering. I do think that he's kind of laid the groundwork for Christine Lagarde in terms of she comes in obviously managing a difficult situation, but I don't think that there's going to be a lot of pressure on her to do anything immediately, at least stepping in the door as we got this stimulus here. So what do you think is going to be some of the first steps that she takes as the new ECB president? My assumption is she picks up the baton on hammering the governments on fiscal stimulus, and that we'll see kind of a combined effort between the IMF, the OECD, and the ECB, all hammering home the points of the need to try to get some of these Northern European misers out off of their pocketbook.
And she's got an interesting situation. I would say, I don't know if you'd agree with this, I would say Mario Draghi is probably one of the best of all time at a central banker press conference. He's like...
Definitely better than Powell.
He could take some notes from that's how you do it, and he always manages to pull it off. He stays right in that zone of just like mechanical, incredible, and this is just the deal, but also ends up, giving enough meat to help everybody understand why they're doing what they're doing, but never puts it into a zone of just shooting from the hip. But
do you think he's helped by the suave Italian accent too?
He's got that going on, but he just seems like he's just like a machine up there.
Yeah.
And Christine Lagarde's got a tough act to follow on that note, but she may be more of like she may be more of a networker. A networker and a deal maker, and I don't know if he's been doing a whole lot of like really kind of getting into the ear of politicians in various countries and meeting with people and trying to express really the point of opening up the federal balance sheet in northern states
from my understanding, his management style, things that I read with regards to his transition to Lagarde, is that he's much more of he takes everything into consideration and then he pushes forward his final decision, whereas Lagarde is much more of a negotiator.
Yeah.
So perhaps that does help out a little bit more in this situation.
She might be able to get some fiscal work on board, try to bring it into the fold, because it would really need to be that the central bank is there and they're working with all the countries to try and create a global win, for the whole system in the EU. And he's kind of like, I'm doing my job, you guys need to do your job. And if she turns it more into, hey, let's all get together and do a job together that works. But again, it's just so hard to move things when you're talking about EU fiscal union and how many different cultures and how many different things that have started to slip toward being sort of a populist, protectionist kind of situation for so many different countries, particularly the ones that don't want to support the ones that need the support, and there's so much there that's such a huge hurdle in terms of actually getting something going that would be something that works better in the Eurozone. Because again, we're talking about, maybe the biggest single economic system on the planet. And it's just mired in what is, I think, just a mechanical flaw in its design from the ground up. And maybe she's going to be able to offer some kind of deal-making quality and meeting with individual government leaders and trying to sell this different approach to doing things that will actually help more than just reducing interest rates further into negative territory.
Well, she'll go down as a European legend if she can, that's for sure, right?
I know. I mean, that's what needs to happen.
Yeah.
Or it's going to fall apart.
The funny thing is that I don't think that that's something people don't understand, that they don't know.
Yeah,
it's
I know.
just, they just haven't been able to get on the same
game theory.
page.
There's a game theory problem there. There's a nasty equilibrium in a bad place.
Yeah.
Yeah.
So, and then, obviously keeping an eye on the rise of populist governments, because that's going to make any such thing that much more difficult to achieve. So,
Sure.
That'll be the backdrop going on behind all this. So with that all in mind, Brett, let's take a look at your trade in the euro and where we stand with that, what your expectations are moving forward, and what you would like to see, what you'd be concerned to see. I don't have euro futures on my charts here, so I'm just going to pull up the FXE and kind of use that as the running chart that we'll take a look at. What kind of time frame you want me to throw this on, Brett?
You could just put in like an hourly chart or something. I mean, as long as we could see back the last couple months and still see some intraday stuff.
If you want to see back the last couple, we'll work bottom up here. So we'll take a look at the 60, and then we could kind of take a look. So let's go.
Well, why don't you just put a daily chart then? So we're just kind of get a sense of where we are in the big picture of that market. And my short is in place from I don't know how to translate an FXC, but probably somewhere around 105.50 or 105.60, something like that. So the basic idea is around any major central bank day, my philosophy is that it takes 24 to 48 hours for the market to really digest things. And you can get really ferocious swings that seem to indicate how this new information is going to be taken by the market and then are reversed completely in both directions. We've seen that both ways today so far in reaction to the euro. I think that if you just pan back, the larger picture is you've got a downtrend that has started to accelerate to some degree. I don't think that this necessarily changes that. I think that, I would like to see this roll down and move through the tail that it created at today's lows. That does kind of set up, you don't see it on the daily chart, but FXE, if you were to see it intraday, got down below 104. And if you move back down through that tail after establishing it as such a tail, you're going to have a ton of stops under there. So I think it'd really be an important development for this trend to now, after establishing that tail, to move back down underneath it. I don't see why it wouldn't eventually, given that the situation that we've talked about as being the driving point of this trend is still absolutely in place. But I'm never one to believe that it's more important to think about what I hope or think a market should do or what I hope a market does, but I'll always respond to what a market does. And if it puts together a response over the next several days that looks like a much more constructive set of moments in the tape, of short-term patterns and the way they stack up, where they're coming together and how they're resolving, that gives me a sense that there's a different kind of market in place, then I'll have an easy time just saying forget it and cover it. But I think that that's not going to happen. I think that we're in a situation where people who are looking for that bottom, and there's a lot of big Wall Street firms that have been bullish on the euro and bearish on the dollar, and they're essentially saying the dollar is overvalued, and they've been saying that for like 6 months. And I think it's an absurd collection of words. There's no valuation for a currency. There's no ground against which to value it. It's something that's a stable concept. So I think that it's really just kind of an odd idea. I think there's directional trends, and I think that the big idea is there a convergence going on between the EU and the United States economically? Is there a situation where it seems right now that the United States exists in a different context that's getting more and more different? Or is it the case that the assumption that the United States is that much in a stronger position than the EU is a false idea, and eventually we're going to see this kind of convergence process happen, which would be the bullish thesis on the euro, and particularly if what the ECB is doing right now is going to make a game-changing difference in the performance of their economy, and they're eventually going to have to reduce this type of stimulus, or if the United States is really starting to slip into it. And I think, again, the big factor is really that it takes a fiscal channel to do that. And that's going to cause an increasing divergence. And I'm still 100% of the belief that that's the case. And I think that we're gradually going to see this roll back over and move through that low and even accelerate as the market starts to kind of put this in context. Because what happened today, it's an interesting set of maneuvers, but when you pan back and you put it in context of the larger trend that's in place and the larger dynamics in place, I don't think it really changes much of anything, but it just suggests that there's going to have to be continued pressure on the ECB that goes far and away above the pressure that's on the Fed, and the results are going to be less because we also have a fiscal channel in the U.S. So I think that ultimately is still the story. But, if it starts to act differently, I'm always 100% more focused on how a market is acting than any of my large abstract ideas about that. So, I would just adjust the position. If it means closing it, that's what it means.
Okay, and obviously one crucial aspect to this position is, of course, the dollar performance, as you mentioned. With that in mind, we got the Fed next week, so we'll take a quick glance at that. But any thoughts on the CPI data this morning, which obviously was overshadowed by Draghi? But you see any impact from the CPI on that euro trade here?
Not really. I mean, wasn't it basically more or less as expected?
Yeah, more or less. A little hotter, which has been the theme since, when you add up average hourly earnings from last week's jobs number to the PPI number to the CPI. Just slightly higher. Not enough to raise a red flag, but certainly enough to perhaps have Fed officials on the easing side tapping the brakes a little bit.
Yeah. Right, and I think that there's been, as we talked about yesterday. Was it yesterday? I think it was. The sentiment flow show, that was yesterday, right? Yeah. So as we talked about then, I think that there's been a larger inflection in interest rates, even in gold and a number of different things where you see, I think, a stepping back from the precipice of expecting some kind of impending move into recession. And I think we were there at times in August. And especially with, all of the different yield curves that were inverting and trying to understand the implications of that. And then we had a few different data points that seemed to kind of show some shadows of that, and especially in PMIs. And we had U.S. manufacturing move into contraction. And there was a narrative there. And that narrative, I think, has been busted. And with the jobs report, with a number of different factors, we're starting to see retail sales will be important tomorrow, but we're starting to see, basically people walking back from the precipice of thinking that there's any chance that the U.S. is going to be in recession sometime within the next quarter or two. So I think that we're starting to back off of that, and I think that should impact what we hear from the Fed, and it certainly, the CPI kind of fits into that same picture, and you're seeing rates move back higher again. You're seeing the 30-year bond futures market move back down. It's checking and moving just under the 50-day average now. So you're seeing a lot of shifts again. I think it's kind of walking back from the idea that there's some kind of imminent recession risk in the U.S. which should help the euro situation. If Draghi's downgrading forecasts and if they're
story.
kind of worried about the slippery slope, they're
Yeah.
moving back into QE and people are walking back away from recession forecasts in the U.S., and I would think that's more divergence.
Okay, and while we're going on here, Brett, looks like that 30-year bond auction went off. Not seeing anything jumping out. Looks like pretty much in line with the average from the last 12 results.
Weak market response, though.
Outside of course, the big dip in yields, which shouldn't be particularly surprising. Perhaps some people would have liked to have seen a little bit more of a stronger market response, or maybe just a little bit of a false breakout here, but nothing's really sticking out too much to me from this 30-year bond auction.
But I mean, again, you're seeing it's the bond market is slipping further.
Yeah,
Rates are popping.
rates popping, market slipping. Yeah, we got TLT down at lows. Pull that up. So, all right, Brett. Anything else to add? I know we're going to be doing a lot of central bank commentary next week, too. We got the Fed, PBOC is expected to jump on, and the Bank of Japan. So anything else you want to add at this point?
No, not really. I mean, we pretty much covered a lot yesterday as far as other markets. So this is just a process. And again, for anybody who's in the Euro short with me, I have a very small position, a very wide sense of it, and I'm not really looking tick for tick. I'm not looking to take advantage of some small thing. I'm looking to hang around in this trade for better or for worse as a larger dynamic over coming weeks and months.
All right, and just one last thing on the yields front. Just keeping an eye on this 10-year. It's coming up. It's a little bit of gap down resistance in that 50-day at that 180 area. So this is going to be a key area for this yield to get over at the moment. So, all right, Brett. Well, we'll continue to be in touch, obviously. And if there's anything you got to say, we'll just keep you online. And if there's anything you feel the need to jump in and add, by all means.
Sounds good.
All right. Talk to you soon.
Okay.